Have you ever wondered how to switch from being an active investor to a passive one? Maybe you're too scared to take the leap, or you're afraid that you don't have enough education. Maybe you're so used to being hands-on and in control that you don't feel comfortable having someone else manage your investment. On today's show, we're going to talk through just that, how to go from being an active investor to a passive investor. Hello, Pocketeers! Welcome to Passive Pockets. I'm your host, Jim Pfeifer. On today's episode, we are discussing how to go from active to passive investing with limited partner investor and Passive Pockets member Travis Henry. On today's episode, you'll hear Travis's investing story and how he moved from active to passive investing. We'll talk about strategies he used to become a passive investor, how he's trading out of some of his active investments to become more passive, and lastly, we'll talk through the diversification strategy in his portfolio. Let's bring on Travis Henry. Travis, welcome to the Passive Investing Show.
Thanks so much, Jim. I'm really looking forward to this. I'm glad to be here.
First question, I'd like to ask is about your real estate journey a little bit. How and when did you first learn about real estate as an investment?
I'll take you all the way back, actually. So I'm originally from Honolulu, Hawaii, and growing up there, everything is really expensive, but it's funny, you don't realize that until you kind of come back as an adult. So I left as a kid, 17 years old, went away to college. I graduated from Western Washington University. For those folks who aren't familiar with Washington, it's pretty much Canada. So we're all the way up north. I studied economics there and joined a bank right out of school as a credit analyst. So I was doing, parsing through a lot of data and really helping to put together any documents for underwriting, commercial loans, that type of thing. And I was working for a key bank in downtown Seattle. So they're headquartered kind of in your neck of the woods. I think Cleveland, Ohio, but you're in Columbus, is that right?
I'm in Columbus now, but it's funny you mention everything being expensive being a Hawaiian. I grew up in Alaska, so I certainly understand the expense of that, and also the Northwest, because we're the closest state to us is Washington as well. So we have a couple connections there.
I was working in downtown Seattle, also not a cheap place to live. But after a few years, I moved back to Hawaii. My wife and I, we met in high school, and so we both moved back to Hawaii and figured, hey, let's put down some roots here. And that was when it really hit us, like the cost of housing, just eggs, milk, just things that magically show up in the fridge when you're living at home as a kid. We were having to buy these things now, and we're thinking, shoot, we need to figure out a way to make more money. That was kind of how I found Bigger Pockets. I started listening to Brandon and Josh on my daily walks to the office, and then eventually David hopped on the show. And so the three of those guys are like older brothers to me that they don't even know I exist, but they were older brothers and really just helped teach me how to invest in rentals and stuff. And so I spent maybe 7 months, just kind of plugging into the podcast, buying people coffees, lunches who were other investors, and said, how are you folks doing it? And so it really helped that I had a background in, analytics and that type of thing. And so we started researching different markets where we could invest, because obviously it was going to be tough to invest in Hawaii. We found Clarksville, Tennessee. So out in the Midwest, we basically said, okay, let's go into that market. Let's figure out how we're going to do this. We want to build up this massive rental portfolio, this empire, and that's how we're going to retire. It's funny because it didn't work out that way, but one of the things that Brandon Turner always talked about, he mentioned kind of these 3 points of a triangle on how to invest in real estate. He said, basically, you've got money, you've got knowledge, and you've got hustle. And he said, the funny thing is you only need 2 of those 3 things to actually make it happen. And so it was easy for us. We spent, 5 seconds figuring out that the money part was the thing that we were missing. And so we just said, hey, look, let's continue to get educated. Let's really figure out how we're going to carve out the time to go and buy rentals and operate a portfolio effectively. We approached my grandparents, said, here's all this economic data. This is why we like Clarksville. Here are some risks, and here's how we're mitigating them. And here's a sample deal. Here's something that we're looking at investing in. We don't have a deal yet, but we're looking at something kind of similar to this. The ask was for $50,000. So we signed a note, 2 years at 8%. We took the $50,000 check and bought a small duplex out in Clarksville. This was in 2018. And so we ended up burring it, which was really scary, right? Because all of this stuff in theory, having listened to stories on the podcast and kind of David talking about, how he just burred a ton of homes, in Jacksonville or wherever. And we were just like, okay, we need to try to put this into practice. And fortunately, we were able to do that. We refinanced the money out, repaid my grandparents a few months early, and took them to a nice dinner. So that was kind of how we got started in rentals.
Funny thing to me is it's very similar to how I started, except I started much, much later in my career than you did. So I'm jealous that you found real estate so much earlier than I did. But I do want to just level set here because I know we're in the Bigger Pockets family now, and Burr is definitely a verb. But for those that aren't quite sure what that means, that's where you buy a property, you rehab it, you rent it, refinance, and then repeat the process. So basically you're getting all your money out so you can go do it all over again. And so that's super interesting. So how did you go from there? So that's similar to me. I had some rentals. I was doing the turnkey, but were you doing turnkey, or were you actually hiring contractors there? Did you go visit there? And then can you also tell us where you went from there? You bought one, two, or did you create an empire?
Yeah, so definitely not the empire part, but I did build out a team there. So, for anyone who's looking to enter a new market, somewhere that's not really familiar to them, somewhere that's not their backyard, it's really important, I think, to find what the BP family calls the core four, right? I mean, I think it's your real estate agent, you got a contractor, lender, and I think property manager was the fourth one. It's been a while, so I'm a little bit rusty, but I will say that building out that team there is going to be really important, and that's exactly what I did. So it's funny, I kind of put the cart before the horse. I built out this team, and then I flew over there and met all of them. Fortunately, all the handshakes went really well, and we still liked each other after the conversation. And so the contractor was the hardest one. I mean, because obviously with the Burr, it was a moderate lift on the duplex that we purchased. So there was still a lot of back and forth and a lot of wrinkles to kind of iron out in that relationship. But we did it successfully, and we basically took that proof of concept and we said, hey, look, what is our advantage here? And Big Brother Brandon always talked about, I got to stop calling him Big Brother Brandon. But Brandon would always talk about, at any age, you basically have an advantage. You just need to figure out what it is. And I took that same approach because I figured, okay, I'm young, but I'm already getting my feet wet. So now what is my advantage here, having this one deal? And I basically said, we're in Hawaii. We might not have a ton of money. We're not particularly high income earners, but we do have friends and family within our network who are, but don't necessarily have the money to invest in a high cost market like Hawaii, but still believe in real estate as an asset class. We took that deal of the duplex and we basically went around to folks and said, here's what we're doing in Clarksville. If we found similar deals or, we wanted to do something else out there, would you be interested in participating? And the pitch was really, hey, would you bring all of the money? We'll do all of the work and you'll essentially just collect mailbox money at that point. Through that process, we found two separate equity partners and ended up buying some existing and building some new construction, small multifamily properties still in Clarksville. And yeah, that's kind of how we built it. It's not necessarily an empire. I would say we got to a little over 30 units or so. And then, for us, we're slowly starting to sell off and redeploy those proceeds into the passive side.
Well, I don't know about you, but I've been to a lot of active real estate meetings, and the first thing everyone asks, or they introduce themselves and then they say the number of units. And I remember when I got to 30 units, and that was about where I topped out at, I thought that was a pretty big achievement, and I thought of myself as having an empire. So that is super impressive, especially doing it in Tennessee when you live in Hawaii. So I want to transition a little bit and talk about passive real estate investing. But first, I want to talk about also your career, right? You're a commercial underwriter for real estate. So can you talk about how that helped you with your active investing? And then we'll transition and talk about how that helps as well with your passive.
Yeah, it's really funny because residential real estate is, a lot of people will say there's some overlap, and maybe there is, but I look at them as very different from, the residential to commercial side. When I was investing on the residential side, maybe some of the jargon or some of the lingo or just the terminology, it helped that I did have some familiarity from my day job. It helped me analyze, some of the, cash on cash numbers, looking at LTV and stuff like that. But I will say that the biggest value has come coincidentally from transitioning over to the passive side, where I'll get an offering memorandum on a multifamily property. And it's just such a seamless transition where I'm looking at rental growth projections, vacancy rates, and, cross-checking that with kind of market data and just validating numbers. It's funny because I always thought that I don't know. I'd never wanted to be a passive investor, but it's just interesting how those two worlds have kind of helped one another.
Yeah, and you mentioned when you're doing the active real estate that, you needed an advantage. And that's what I say the same thing to people is when you're going to be active, especially if you don't know a market better than someone else, or you don't know how to swing a hammer better, or any of these other things, and you don't have an advantage, then maybe you're better off going passive because you don't need all those advantages necessarily because you hire an asset manager who will put all those people in place that have those advantages. So in passive, then, what is your advantage? Is it that you work in commercial real estate so you understand the world a little bit?
I think it's still being aware that you will have blind spots. And that's where I think that there is such a big value add component to something like Passive Pockets, right? Where you have this community of folks. Coming out of school, this is kind of a side story, but you'll get it. I'll bring us back. Coming out of school, I wanted to become a management consultant. And the reason for that is I just had a few interactions with just wicked sharp people, right? But they had these interesting backgrounds. Like some of them came from teaching, some of them were physicists by trade, but they all came together onto this team and they approached a problem from these different angles and they came to a solution and made recommendations to their client. And I thought that was such an interesting, just a collaboration between minds that just look at a problem differently. And I think that you have that same thing on something like Passive Pockets where everyone comes from a different professional background, all have achieved some level of success, presumably. I mean, considering that, they're high income earners or have a high net worth, they did something right. And so all of these folks are kind of collaborating in this forum where we can look at the same deal but come to completely different conclusions. Not to mention, we're at different parts of our lives. I've got a young daughter. Maybe some other folks are empty nesters and don't have to think about funding college. But nevertheless, there's true value in having that community aspect. And just being aware that you do have those blind spots, you can fill those in, even if you do have an advantage like I might have underwriting commercial real estate day to day.
That is well said. As someone who, I've been on a lot of podcasts and I've hosted quite a few, and I'm constantly talking about the value of community. And I don't think it could be said better than you just did. It really is about bringing other perspectives, not only just discussing deals, but everybody has a different skill set. And so what you basically just said is, what you do in a community like this is you take everybody's advantage and it becomes yours. So now instead of just you being a commercial underwriter and being able to, bring that perspective, you have all these other perspectives. So I think that's just a phenomenal way to explain that. Thank you for that. You were an active investor and then you chose to kind of pivot and get into passive investing. Why did you make that choice? We see a lot of people who kind of graduate, we put it in air quotes, from bigger pockets and go into passive investing because they want to get less active. Is that what it was for you? Or was it an economic reason or was it a time reason or something completely different?
The big one was time. My wife and I, we started, our family. I mean, we have a now 4-year-old who's going to be 5 in 3 days here. But it was just, looking at the portfolio that we had and the amount of cash flow that we were generating off of it. I'll say that I'm not a control freak. At least I don't think so. I like to delegate a lot, but there was still a lot of things that needed my input, and in order to keep the portfolio running smoothly and come tax time, I mean, it's just a nightmare, and so we basically looked at it and said, in order for us to get to the number that we want, we're going to have to scale this portfolio to a point that might not be sustainable, at least not as far as mental bandwidth or just capacity overall. And so we said, look, it would be nice to be able to put money into somebody else's deal that they're quarterbacking. Let's just evaluate a lot on the front end and just kind of have these touch points where we're checking in every so often periodically and not necessarily have to worry about the day-to-day stuff that we're doing with our active portfolio. So yeah, the big one was the time component and just looking ahead and seeing where it was going to lead if we kept on this path and in trying to reach our financial goals.
And so you made this decision together with your wife. Were you both involved in the active real estate? And will it be similar in the passive real estate investing you do?
Early on, she did not want anything to do with it. She just kind of trusted me and said, okay, like you're the one that lives in spreadsheets. You're the one that geeks out over a calculator, you weirdo. You go figure this out and I trust you. It's been huge in our marriage, just to be able to, for me to just not necessarily push it on her, but to get her thoughts, here's what I'm thinking. What do you think? There's been many times where she's said, I just don't feel good about this. Or something about this person just doesn't feel right. For me, I mean, it took a little while, but now that's a hard stop, just trusting my wife's intuition. And I will say, for all you fellas out there, I mean, they've got this weird spidey sense where they've got this intuition where now I'm just not going to go against my wife, right? And fortunately for me, it didn't take losing a big pot of money or losing anything for me to realize that or come to that conclusion. But she wasn't involved early on. Now I will say that she is involved on a limited basis, just to the extent that she wants to be.
That's super interesting because when we started out, my wife was kind of involved, but then, we couldn't coordinate schedules and she got less involved. But on the evaluating a person, like first impressions, second impressions, third impressions, she has found out people that I should be avoiding and told me, well in advance of them actually doing something where I figured that out. And now I definitely listen to her intuition or whatever it is, but she can suss them out just like your wife. It's pretty amazing. So I want to talk about the transition. Was it difficult to transition from active to passive? You mentioned control, and that was one thing for me that, I am a control freak on certain things, but on real estate, I was like, yes, please, somebody else take control because I wasn't very good at active investing and you were, so that's different. But what was the transition like and was it difficult for you?
I wouldn't say that the transition was difficult. It was a different set of risks, right? It was a different risk profile. It was a different process as far as evaluating the sponsor. And that's what you're doing, right? You're going from vetting specific real estate deals. You're still doing that, but you're also having to vet the operator. And on the credit side, as far as working in a bank, the number one credit risk is character. So even if a deal checks all the boxes, but we're a little nervous about the person that's running the whole thing, we're not going to do it. You really got to lean into the character and figure out who it is that you're working with. Because one of the biggest things is the illiquidity, right? When we're talking about control, yeah, that's a big part. And anything in my personal portfolio, if I want to refinance or I think it's a good time to sell, I just get on the phone with my broker and we just figure that out. You don't get a seat at the table when it comes to syndications and funds, right? And you're just kind of like, hey, I did all the due diligence I could up front. Now I'm along for the ride. And so I think that understanding that and balancing it, figuring out like, what is your risk appetite? How much liquidity do you really need? And making sure that you are balancing that massive illiquidity on the passive side with maybe, I don't know, equity investments or even just cash in an account. Just making sure that you're taking the steps necessary to craft a really balanced portfolio. Because at the end of the day, that's what we're doing. We're building bespoke portfolios that are unique to our situation, our unique circumstances. And just being thoughtful about that, I think, is going to go a long way.
You said it again there, liquidity. And, I've been doing this quite a bit longer than you have, but it took me a lot longer to figure out that liquidity is an issue, right? Because these are such illiquid long-term investments completely out of your control. Just looking at it, real estate, when you buy a single-family home in Tennessee, that's real estate, so it seems illiquid compared to cash and investments. But then if you buy, let's say, an apartment complex that somebody else in a syndication, right? You buy into a syndication, someone else is managing and operating, that seems like the same amount of liquidity, but it's really not. And I figured that out finally. So can you talk about what the differences in liquidity between, say, your cash investments or stock market investments, your self-managed active real estate, and then the syndication investments you're in?
Real estate is illiquid. That's true. But I will say that if you've got an actively managed portfolio, any of your real estate holdings are liquid at a given price, right? I mean, if I wanted to liquidate a single family home in Tennessee tomorrow, probably couldn't do it tomorrow, but if you give me 2 weeks, I could probably do it pretty quickly, right? I would just have to price it such that it's below the market. I mean, I would have to price it at a pretty steep discount, but it is liquid in that sense. That's really unlike any other investments that we have in syndications or funds. Even if I had this dire need for cash, there's no way a sponsor is going to look at me and say, hey, thanks for your $50,000 investment into this multi-million-dollar deal. Yeah, let me try to figure out a way to get your $50K back. You just don't have that option. And so you do have a lot more flexibility when it comes to your own personal portfolio. And I think, again, just being aware that doesn't exist on the passive side is a really critical component, because you'd hate to be locked up in something that has a 5 to 7 year hold and you just, you didn't realize, hey, I can't quite click a button and get that liquidity. Yeah,
that's well said, because, for me, when I started in this, the deals were often going full cycle in 18 months, 2 years, 3 years, when they were, targeted to be 5 years. So it felt like everything was more liquid than it was. And then when the market changed, I realized, oops, I went all in on syndications because I was so excited about it. And now the liquidity has dried up even more, even though those were not as liquid as regular real estate. So that was really well explained. When you were doing this transition to, be more passive, how did you educate yourself and how did you get comfortable with this new type of investing, not only giving up control, but now you're not just in one market, you're not just in Tennessee. Presumably you could be anywhere, right? So you have different markets, you have to vet these operators. How did you get yourself educated?
I went back to square one. I mean, the way that I got educated on the residential side was through BP and a lot of the books that are published through Bigger Pockets. I did a lot of the same things as far as trying to learn this new side of investing. So picking up a couple of books. I mean, Brian Burke's Hands Off Investor is one that's always finding its way onto my desk. It's just one that's really easy to reference. Steve Sue from Left Field Investors wrote an excellent book on rookie mistakes. That was a big one. And so just kind of going through different literature and trying to learn how people are approaching this. Steve's perspective is really unique because it's coming from an investor. I know that Brian Burke invests also, but he's writing it as a sponsor, I think. And so just kind of getting plugged into different communities, just exchanging ideas with folks, putting yourself out there, really. I mean, you're exchanging messages on a forum with complete strangers. The only idea you have of what they look like is from whatever profile picture they put up. I will say that beyond just connecting with people and exchanging messages through LFI, I've reached out to folks and gotten on separate calls, and it's really allowed for a more intimate exchange, understanding each other's goals and just learning from each other's experiences, really. Again, going back to the advantages, really digging into maybe details that people don't want to be putting out publicly, but would be willing to share once there is some familiarity. It takes some time to develop that connection and to be able to be vulnerable with somebody and express maybe all of the mistakes and your shortcomings. So even beyond just getting plugged into a community, reach out to folks and try to develop an intimate connection, which has been kind of tough after coming out of COVID.
That's a great recommendation. And those two books that you mentioned are 100% favorites for me, and I've read them multiple times. The good thing is that the Passive Investing Mistakes book by Steve Sue is now a free ebook for anyone who joins the Passive Pockets community. So you can get that instantly when you join. So all the content, they just restructured a little bit. So that's pretty exciting. Now I want to get into, when you transition to passive investing, now you're able to look at a lot more asset classes, a lot different deals. What was your buy box when you started in passive, and how has that evolved the more you invested? And we're talking about different asset classes, different markets. You just kind of talk about what you're investing into.
So I think I have a strong bent toward multifamily, and I don't think that that's going to change. So I think as we've started to structure our target portfolio, multifamily has been a very large component. I think it comes a lot more intuitively for a lot of folks. I mean, we've all rented apartments at some point. We all kind of understand what it means for a unit to go vacant, and then for, the process of turning a unit, getting it rent ready, installing new carpet, new paint, that type of thing. I think that's something that's really familiar. I think what's less familiar is maybe something like a triple net industrial building. Maybe some of us aren't as familiar with how that works, but I do think that the fundamentals around multifamily real estate are strong. I think that's kind of how we're going to build out the core of the portfolio. And I think if you have that understanding of where you want your core of your portfolio to be, you can be a little bit riskier with these smaller satellite positions. So maybe we'll keep that core intact and then have smaller positions in mobile home parks or self-storage or industrial triple net type properties, but always maintaining, a solid chunk of equity on the multifamily side. To be completely honest and transparent, I mean, most of the commercial real estate that I underwrite tends to be multifamily also. So there are more reps that I've gone through on the multifamily side than, say, evaluating a retail center or something like that. So I do feel like there is some safety in having those repetitions behind me, having a little bit more background knowledge. And again, just going back to just an intuitive understanding of, how an apartment typically functions. So that's kind of the idea, is that we want to keep that main core and then have these smaller satellite offshoots that will invest smaller chunks. Now, it is a little bit challenging when you have high minimums, right? If you've got a sponsor that has $100,000 minimum and they're not willing to budge, having a smaller satellite position in that means you've got to have a ton of investable equity. And so that might not be something that you can do right away, but obviously you can invest smaller chunks of equity to kind of diversify and spread out a smaller amount of equity from the beginning. So that's kind of the way that we approached it, is just building out that core and then slowly having these smaller investments elsewhere.
Going a little bit deeper into that, how do you evaluate these? Are you looking at, Class A, Class B, heavy value add? What markets are you looking at? Can you just go into a little bit of detail on what you're investing in regarding the multifamily?
Given the timing of when I switched over to more passive investing, the spreads and cap rates between, let's say, multifamily properties, class A, B, and C, there wasn't this huge delta, right? And so a lot of the operators that I was looking at were picking up these class A properties, and it wasn't so different from like a class C, that there was a lot more underlying risk, or let's say operational risk to their business plan, right? If they were going to plan to do a heavy lift on the renovation, but then you also had this other opportunity that was a class A, hey, maybe we're going to do some turns of 10% of the units, but for the most part it's all intact and it's owned by an institutional group right now. That's who we're buying it from. That's kind of the way that I've leaned, just because of the timing of where we're at, and then also the opportunities that have come across my desk. So I wouldn't say that I'm opposed to, more value add type opportunities. I will just say that the opportunities that have come up have been, the stronger ones have been the class A, more conservative type deals where it's really just mismanaged, right? Where it's like, hey, let's just put proper management in place and we'll be able to improve the operations and subsequently the NOI.
Everything you're saying is making sense to me for sure, because what's happened is it's risk reward, right? So typically a class C or a class B property or a heavy value add property, you would expect to get a higher return for those properties because they're a little bit more risky than a fully stabilized, already renovated or brand new class A property that is going to be, typically has lower risk. Well, now the risk profiles are similar in those. So why wouldn't you go with just the property that is a little bit nicer, a little bit safer? Now, in your real estate, it sounds like everything's just gone perfectly and swimmingly, and it's just been sunshine and roses all day long. That was not my experience, but have you had any struggles or failures passively? We're going to just stick with the passive investing now. Have there been any capital calls, a difficult time in the market? I don't know if you started your passive journey before or after all of that happened, but can you kind of talk about any struggles that you might have had?
No struggles on the passive side, although there were things that kind of came up pretty early on that I've realized, hey, this was kind of a flaw in your process, you've overlooked it. And unfortunately, you can't rectify those with the sponsors that you're already invested with. Like I said, you're along for the ride for the next 5 years or so. And so nothing really we could do about that now, but it is funny how quickly you realize that you've overlooked something, like something as simple as asking for sample reporting, right? Something that I should have just done from the very beginning. People have told me that, and I don't know why I didn't do it. And so now whenever I get monthly reporting from one particular sponsor, I'm always going back with specific questions. Hey, how is this debt service coverage calculation put together? What are the underlying assumptions here with this statement or with that, right? And unfortunately, that email exchange takes a few days, and so it takes some time to get the answers. And sometimes they need to go back and ask the team, hey, what are our assumptions here, or what are we doing to address this? And there have been other groups where they just put that together in their reporting, and it's so nice to just call out things that I don't even see, but things that are coming down the pike for the property, and they just say, hey, look, here's something that popped up, here's how we're addressing it, we'll provide an update on it on the next reporting. That's been really nice, to be able to see that contrast and go, hey, this is something I really need to focus on. I need to make sure that I'm comfortable with the level of reporting that I'm getting, so that I don't need to spend so much time asking the questions. I want that to already be addressed in the material.
Well, I think asking for sample reports and testing an operator's communication before you invest is absolutely critical. So can you talk a little bit about what's missing from those reports that you have to then go back and ask that, in that one operator where the other operators already provide that?
One of the things is just having a simple section. And I might be unfairly criticizing this one sponsor, because in our credit memos, when we write them up, we have a section where we identify key credit risks and then we mitigate them. In some of the reporting that I've seen from other sponsors, I've seen this section in there where they go, here are some of the risks that the property is facing. Here's how we're mitigating them, because it doesn't help to really point out a problem without offering a solution. And so just as an example, this one sponsor, I hate picking on them, that I have to constantly go back for with questions, is they'll point out a problem like, oh, hey, there's been delays on this material. It's kind of like, okay, well then what is that going to do as far as your actuals to pro forma, or like what are we expecting this as far as an impact? Is it going to be immaterial? Like, are you just mentioning that because you needed to fill space on an update, or is this something that should be concerning? Should we expect that it's going to, there's not going to be any movement on the leasing activity or anything like that. And so those types of things, I feel like by addressing them ahead of time. I mean, listen, we've all been to a restaurant where you have a server that just happens to anticipate anything that you need, and they're just dropping silverware, they're dropping whatever you need. It's like, whoa, that just showed up. On the other hand, it's like you try to wave down a server at another restaurant and they're like ignoring you on purpose. And you're like, hey, you didn't even give me a plate, And so it seems so obvious, but I think that those things get overlooked, and just really finding a sponsor that addresses those concerns preemptively, I think is really important. I mean, it's impressive because not everyone does it.
Yeah, that was a great way to explain that for sure with the restaurant example. And then real quickly, if you had gotten a sample report prior to investing with that operator, would you have invested, or would that have been like a red flag enough that you said, you know what, I'll pass on this one?
I don't think it would have been a red flag. And unfortunately, it's taken time for me to collect sample reporting from other operators to then have a yardstick to measure the current one against. For me, obviously, I had those questions, but I would think, hey, maybe no issues will come up, or maybe it'll be a quick email exchange. Hey, what's going on with this? Not realizing that I'm going to have to ask questions, or I'm going to have questions that I want to ask at every monthly interval, right? And if I have, 50 investments that all take that time, it's not very passive anymore, and I don't think it should be. I think that investors should take an active role, even in their passive investments, by making sure that, things are performing according to plan, and figuring out how they need to restructure the allocations on their investments outside of private equity real estate, but depending on what's happening on their private real estate holdings. So I will say that there was some expectation of having to be active, just not to this extent with this particular operator.
So you're in the transition period between active and passive. So what is the split currently between those two parts of your real estate investments, and where do you think that's going to be in the future? What's your goal for this split?
It's funny you asked that, because I do have a pie chart up here. So I've got, currently about 60% of our real estate holdings are in the active bucket. Those are any properties that are owned within these entities with the partners, or things that my wife and I own personally. And then the remainder is in the private equity space. The goal is to eventually transition out of pretty much all of our active stuff and invest exclusively in real estate private equity. I will say, though, that initially we didn't want to hold anything in traditional equities or, stocks and bonds type. But I will say that balancing that illiquidity that comes with investing in these offerings, you do need to have some plan for maintaining liquidity. So instead of just holding a ton of cash, I think we're going to have to balance it out with some growth on our equity side. And I think that's going to be something that we plan to do over the next, say, 10 years or so.
Yeah, that's funny. That's another mistake that I made with my illiquidity, is I was just so done with the stock market and all of that, and I thought there's no place for that. But then that is where I store my liquidity now, that and permanent life insurance, because those two places I can also grow. There's some return on those. It doesn't just sit there making 0.01%. And that's been a big conversation in the forums, as you know. When you go from active to passive, a lot of people look at that and say, okay, but then that's going to hurt my returns, right? I'm not going to make as much money on my passive investment. That's not my experience. But can you talk about how the returns compare between active and passive? And I want to focus on your return on investment, right? So the money you're making, but also your return on time.
It's funny you say that, because that's exactly where I was going to go, was return on time. It's incalculable. Like, I will say that I tinker too much in spreadsheets. I tinker more so on the stuff that we hold actively than I do passively, which is, my wife appreciates it. My daughter appreciates it. But, as far as the returns go, if you're somebody that has active rentals in your portfolio, the mistake that I made was looking at cash on cash. Always looking at cash on cash. I think that you should look at cash on cash when you're considering an acquisition. I think over time, when you go through a period, especially like we have, I think this is a very unique period that we've gone through where there's been this run up in values. I think the appropriate way to look at your active holdings is return on equity. That's the metric that we should be looking at. And so when I looked at, the things that we were holding, the return on equity was substantially less than the return on our invested capital in that property, right? That's to say, like, if we were to sell the property today, take that equity and reinvest it, could we earn a higher return than what we were earning on that property? The answer the majority of the time is yes. And I'm talking like the ROE was maybe 3%, right? So even if you take that money and invest it into a value add multifamily deal, that there is this natural J curve where the returns in the beginning are very small, but over time they increase as the property stabilizes. And then there's this pop at the end, hopefully. That ROE of 3% is nothing. I mean, you shouldn't be interested in that. And that's assuming, of course, that you can give up control and still have your sanity and, you're okay with the illiquidity. But if you're okay with all of those things and you're just looking at it on a purely return basis, don't look at the cash on cash, because some of these properties, the cash on cash might be, 12%, 13%, but really the ROE on the equity that's locked up in that property, it's much smaller. And so that's kind of the way that we looked at the different properties and timing the sale and the exits of those properties and then redeploying.
And the tax treatment, because real estate, that's one of the biggest reasons why we invest in real estate, right? The biggest rotor of your wealth is taxes. So do you see a bigger tax benefit in the active side, the passive side, or is it similar?
The passive side has been crazy, actually. To be fair, I mean, 2023 was our first tax filing year since investing passively. We made our first investment January 2023. Shout out to you, Jim, because the lazy 1031, that's the way to go when you're transitioning out, and you wrote an excellent article on that. And so that benefit of having the accelerated depreciation, the bonus depreciation, and to be able to offset the sale of a property. So we sold that duplex that we originally bought in 2018. We sold that in early 2023 and then redeployed those funds. The gain was completely wiped out. I mean, it was completely offset by the cost segregation study on a few apartment buildings. And so just seeing that, I think those benefits definitely outweigh anything we were seeing as far as, just having an actively managed portfolio.
Yeah, and so you mentioned lazy 1031. That is one of my favorite strategies. So I do want to explain that real quick for our listeners. You can do it with your passive to passive or active to passive, but Travis, just like you, when I did my transition from active to passive all in pretty much 1 year. So I had a bunch of gain, right? So all of this gain from the real estate that I sold that went way up, I didn't know what to do about it. So the lazy 1031, instead of doing a regular 1031 with all the rules and regulations, the lazy 1031 basically, and it was when bonus depreciation was 100%. And what that means is you get depreciation, but with the tax rules, you can, instead of having it be a chunk every year, you can basically put a bunch of it in year one. So you get a huge tax loss in year one when you invest in these deals that do the depreciation this way. So what that gives you is, say you invest $50,000 in a multifamily apartment, you might get 70% or 80% or whatever it is. You might get a big chunk of paper loss. So let's say that loss is $35,000 in year one. Well, you're not getting much cash flow off of that passive deal. So almost all of that $35,000 in loss can be taken up by the profit you made on your active real estate. So when you sell active real estate, you have a tax gain, and then you can go and invest it passively and get that depreciation loss all in 1 year, and it offsets the gain on that sale. So I sold a lot of real estate, and like you, I paid zero taxes on it. So I just wanted to let everyone know what that lazy 1031 strategy is. And that article is up on Passive Pockets for anyone who is interested. So before we get out of here, do you have any final advice for members who are just starting out? Either they have an active portfolio and they're thinking of becoming more passive, or they're, have a high paying W-2 and they just want to get into passive real estate and kind of skip the active side. Do you have any recommendations or final advice?
Let me start with this one is going back to kind of when you've got a partner in a spouse and, and you guys are talking about kind of how you want to go about building a portfolio and what that means. I think that talking about specific goals is very important. We talk a lot about how much we want to fund for our daughter. Do we want to fully fund a college education, even if we have, if we have the ability to do so? Is that something we should do? What about buying her first house? And, how are we building a portfolio here today that's going to help us achieve those goals down the road? And I think that is something that my wife can grab onto a lot easier than the actual nitty gritty details of a self-storage deal, but to say that, hey, this is what we're going to do, and this has got a 7-year time horizon, or the business plan is going to take 7 years to execute, rather. I think for her to be able to put that into years in our daughter's life and figuring out where she's going to be and planning that way, I think is a lot more fun. And so I will say, if you can bring your partner on board, if they're willing, that would be one piece of advice. And I understand that that's probably more relational than it is deal specific or investing specific. But, the last thing is there is a way to do it. You just don't know it yet. And since we're on the topic of lazy 1031s, I mean, that was it. I'm just thinking, how in the world am I going to sell off all of these properties, eat that capital gain hit, pay the depreciation recapture, and be happy about the net sales proceeds? I'm not. But to come across something like there is a way, and it's called a lazy 1031, and you don't have to make a decision in 45 days, right? Or whatever it is, to have a gun to your head that way, just knowing that that's out there, it's another tool in your toolbox, and it's something that you can utilize. And so I will say that education is huge. You've got to try to figure out, how do I do this, right? Again, big brother Brandon, how do I do this rather than can I do this? And once you ask that question, I think it'll lead to a lot more exploration, a lot more productive line of questioning that follows. That would be my greatest piece of advice, man, is lean into the educational component and keep asking questions.
Yeah, that's fabulous. And thank you so much for being on the show. Thank you for being part of the Passive Pockets community. We appreciate you. This was an excellent episode and certainly learned a lot. So thank you very much.
Thanks, Jim. I had a great time.
Thank you so much for listening. If you want to learn more about passive investing, make sure to visit www.passivepockets.com and sign up for a free trial.